All right, let's get right into this explainer and see exactly how a massive geopolitical headline connects straight to your wallet. You've probably seen the breaking news regarding a framework for a peace deal between the United States and Iran. But listen, this isn't just about foreign policy. It's a massive economic catalyst. We are talking about something that's going to directly influence gas prices, dictate the Federal Reserve's next move, and deeply impact the trillion-dollar artificial intelligence supercycle that is driving the markets right now. So, to position your portfolio correctly, we really need to unpack the financial mechanics behind this deal.
Here's our roadmap for today. 1. The surprise peace deal. 2. The Fed's master plan. 3. Oil, inflation, and rates. 4. The AI supercycle shift. And finally, number 5, how to prepare now. We're going to zoom way out to look at global superpowers and the Fed, and then zoom right back in to give you some actionable takeaways for your investments.
Kicking things off with Section 1, the surprise peace deal. Let's look at the specific trending news that makes this whole situation incredibly urgent for the global economy. To understand the stakes, we have to look at our safety net. And the context here is absolutely critical. The U.S. Strategic Petroleum Reserve currently has less than 80 days of emergency oil left. Think about that for a second. This stockpile is supposed to act like a giant shock absorber for the economy, keeping your gas prices somewhat stable during a crisis. But with less than 80 days left in the tank, our cushion is essentially gone. So you might be wondering, what does a fragile peace deal framework in the Middle East actually have to do with the price you pay at the pump? Well, everything, honestly. With reports that a framework was signed and then almost immediately breached, the stability of the Strait of Hormuz is in serious jeopardy. That single waterway controls roughly 20% of the entire world's oil supply. If tensions escalate and that strait gets shut down, while our emergency reserve is sitting there depleted, we are looking at an immediate, brutal spike in global oil prices. And as we all know, when oil goes up, inflation goes right up with it. Moving into Section 2, the Fed's master plan. This geopolitical tension perfectly highlights why the Federal Reserve is panicking a bit behind the scenes, strategizing heavily as inflation threatens to rear its ugly head again. Take a look at this data from the CME FedWatch tool. It is showing a massive 97.4% probability of zero changes to the federal funds rate at their next meeting, meaning the market has already completely priced this in. So, the real market-moving news you need to watch for? It isn't going to be the interest rate number itself. It's going to be the Fed's subtle signaling and the secret cover story they use to navigate our massive national debt without triggering an all-out inflation crisis. Let's break down how this fits into the broader economic playbook being discussed by key financial figures like Kevin Warsh. It's basically a 3-step checklist designed to silently inject liquidity into the market without looking like traditional money printing. Step 1, lower short-term rates to fuel growth. Step 2, shrink the balance sheet so the Fed at least appears to maintain a responsible posture. And Step 3, which is the real key here, deregulating the banks. And that brings us to this specific regulation, the SLR, or Supplemental Leverage Ratio. Now, this is a post-2008 rule that basically puts a cap on how many treasury bonds a bank can hold against their capital. The crucial point is that by removing or even just tweaking this SLR limit, banks can suddenly buy up massive amounts of U.S. treasuries. It's essentially a backdoor for quantitative easing. The Fed isn't directly printing the money, they're just letting the commercial banking system do the heavy lifting, pocket the spread, and loan that money out to Main Street. Why is this kind of financial gymnastics so absolutely critical right this second? Well, because the U.S. Treasury has to sell or refinance a mind-boggling $8 trillion in bonds over the next 12 months. $8 trillion. They desperately need reliable buyers for all that debt. If foreign central banks aren't stepping up to buy, domestic commercial banks have to. But there is a giant roadblock threatening to ruin this entire setup. Which brings us to Section 3, oil, inflation, and rates. Here is the giant wrench in the gears of the Fed's master plan, global conflict. It is a complete tug-of-war between the Fed's strategy and geopolitical reality. For the Fed's whole banking mechanism to actually work, they desperately need a steep yield curve where short-term borrowing is cheap and long-term lending pays out high. That is how banks turn a profit, right? But war is inherently inflationary. It creates supply chain shocks, it spikes oil prices, and it forces short-term rates higher. This completely flattens out the yield curve. And without a steep curve, banks simply won't take the risk of buying long-term treasuries, and the whole financial engine just stalls out. Moving on to Section 4, the AI Supercycle shift. This tension brings us to a massive, structural transition happening right now in how capital is organized on a global scale. We're literally watching a clash of titans here. For decades, our global economy was heavily influenced by the financial and military industrial complexes. That's a business model that actually generates massive economic activity through conflict, weapons contracts, and post-war rebuilding. But today, a new power player has entered the chat: the technological industrial complex. We are watching a high-stakes tug-of-war between an old forever war economy that thrives on chaos and the new tech model that absolutely requires global stability. There's a quote from our source material that just flawlessly explains this shift. You can't build a trillion-dollar AI grid in a world that's always on fire. The powers driving the AI supercycle, the massive data centers, the intricate semiconductor supply chains, the huge energy grids needed to train AI, they need open shipping lanes. They need cheap energy. They need predictable markets. That is exactly why there is this immense unified pressure from both the tech and financial sectors to get a stable peace deal finalized in the Middle East right now. They need the world to calm down so they can build the future. All right, Section 5, how to prepare now. Let's bring this all back home. What does this massive geopolitical and technological tug-of-war actually mean for regular investors like you? Depending on how these geopolitical dominoes fall, the Federal Reserve is going to be forced on one of two very clear paths. Path 1, the peace deal holds, oil stabilizes, and the Fed hints at looser policy and bank deregulation. If you hear that, historical data suggests risk assets, things like stocks, gold, and crypto, will likely rally hard as liquidity floods the market. But Path 2, the deal falls apart, oil spikes, and the Fed is forced to stay hawkish to fight off inflation. In that scenario, expect the broader markets to take a dip as borrowing costs stay suffocatingly high. This is why you need to listen incredibly closely to the exact wording the Fed uses in their upcoming press conferences. As we wrap up this explainer, I want you to ask yourself, which system is ultimately going to win out? The profitable chaos of the old war model, or the engineered stability of the new AI supercycle? Because the answer to that question is going to dictate the direction of the markets for the next decade. Don't just trade the daily headlines. Watch the infrastructure, watch the bond market, and make absolutely sure your portfolio is strategically prepared for either outcome. Keep learning, stay focused, and I'll catch you in the next explainer.